They promised 8% returns and handed investors nothing but lies, lawsuits, and loss of lifetime savings. Today, we're breaking down one of the largest private equity frauds in U.S. history, how GPB Capital, led by David Gentile and Jeffry Schneider, scammed over 17,000 investors out of more than $1.7 billion. David Gentile was the founder and CEO of GPB Capital Holdings, and Jeffry Schneider ran Ascendant Capital, the firm's main fundraising arm. Together, they promised big returns from investments in car dealerships, waste management, and other boring but profitable businesses. They promised monthly distributions and consistent returns, 8% annually, like clockwork. What they didn't tell investors was that much of those returns weren't profits at all. They were just giving people back their own money or someone else's. The SEC called it a Ponzi-like scheme dressed up as private equity. In classic fraud fashion, they cooked the books. Gentile, Schneider, and GPB's chief compliance officer, Jeffrey Lash, were charged with falsifying financial statements and lying to investors. They used the illusion of success to raise even more money. And while investors thought their funds were safe, the firm's leadership was siphoning millions for themselves. GPB stopped paying distributions in 2018. They didn't even file audited financial statements for years. And that's when red flags turned into full-blown alarms. Regulators pounced. The FBI raided GPB's offices, and the SEC filed suit. In 2021, the DOJ indicted Gentile and Schneider on criminal charges, including securities fraud and wire fraud. The damage? Over $1.7 billion gone. Some investors lost their entire life savings. So what should have tipped people off? Well, first, GPB promised high, steady returns that rarely fluctuated. Real investments don't work that way. Second, they delayed filings and avoided transparency. And third, most damning, they paid distributions from new investor money. So how can you protect yourself? Always verify that a fund's financials are independently audited and up to date. Second, be suspicious of consistently high returns. And third, avoid advisors or funds that refuse to explain exactly where the returns come from. This case is still unfolding. Want more fraud stories like this? Be sure to like and subscribe.